Everybody got a different version of me. Everybody gotta be learning from me. Everybody wanna be working with me. And I feel like there's uncertainty and urgency to find out what you wanna be. But honestly, we change our minds constantly, so stop and breathe to find out who you wanna be.
Alright, welcome back to MMGinvest. First of all, this is not financial advice. Consult your financial advisor before buying anything. I am not your financial advisor. Stocks, equities, extremely volatile, extremely risky. Do not invest in anything you're not willing to lose or lose sleep over. This is more of an educational channel, and you just listen to me rant about economics and the stock market, and I give my opinions on stocks, right? Alright, so the FOMC was today, and Powell only cut 25 basis points, which, like I said in my last video that I posted last night, that's already priced into the market. So, but, you know, today there was a knee-jerk reaction across the board. I'll talk about that in a second. I'm going to do charts, and I'll give you guys my opinions on what I think is going to happen after this Fed minutes. But first, let's take a look at a few things he did say. Also, it was funny. During his speech, Trump tweeted, "Jay Powell and the Federal Reserve fail again. No guts, no sense, no vision. A terrible communicator." And with exclamation points. Anyways, one of the journalists at the conference literally was watching Trump's Twitter account and asked Powell during the conference. It was kind of funny. All right, so let's listen to a few things he says, and I'll give you guys my opinions. I didn't prepare this, so, you know, it's not going to be smooth. Oh, no. Not this guy. Hi, I'm Jason Bond, and I do Jason Bond picks. We do real money options trading. Real money. Like, who does fake money? Those stupid commercials on YouTube. Alright. Let's start. Where did I start? I don't know. Let's see what he's saying over here.
Is organic growth in the balance sheet enough to get back to a point of ample reserves that can get us through those tough times? Or would you need to see something a little bit above that? And is that a possibility the committee would consider?
You know, I think it's hard to deal with every hypothetical possibility. I think for the foreseeable future, we're going to be looking at, if needed, doing the sorts of things that we did the last 2 days, these temporary open market operations. That'll be the tool that we use. And the question will be then, as we go through quarter end, as we learn more, you know, how much of this really has to do with the level of reserves. And I think we'll learn quite a lot in the next 6 weeks.
All right, he's talking about the repo. I talked about it in my last video. Listen. Okay, first of all, let's just let me talk here. What I really hate about these FOMC meetings, they talk like wizards. They call it Fed speak. And not only do they sound like liars most of the time, but they can't ever give you a direct answer. Or it always seems like there's a hidden agenda behind it, which there probably is. So it comes to question, are they clueless? Are they puppets? Is there, you know, some elite bajillionaire, 95 years old, who lives off of baby blood or something? Are they controlling the Fed? Or is the market controlling the Fed? Or is the Fed just out of control? Are these just a bunch of baby boomers who literally believe their own models and they're not really sure of what they're doing? Or are they just being political right now? These are the things going through my mind. I honestly don't know. It almost seems like he believes what he's saying. It sounds like they're clueless, but they have to know. They have to know that they've blown a bubble. So before I keep doing this, let me just say a few things. All right. Imagine the United States, right, as a person. The United States the United States in the late 80s and the early 90s became a part-time worker because the United States couldn't compete on a global scale because of high regulations and taxes and competition from China and the rest of the world because it's a globalized economy. So the United States became a part-time worker like in the 80s and 90s. In the 2000s, after the NASDAQ bubble, he pretty much lost his job. So what did the United States do as a person? Well, he still had good credit because he has the world reserve currency. And then the United States started taking out credit cards. Okay? And that's what the Fed pretty much did. This analogy is trying to explain. So the United States took out a bunch of credit cards. And the United States hopes that his job's going to come back. But in the meantime, he's just going to rack up these credit cards. And every time the central bank lowers interest rates or does quantitative easing or buys assets or whatever on the open market or goes in, who knows, they're going to end up buying stocks probably too. Whenever the Fed does stuff like that, that's essentially getting a new credit card and paying off your previous credit card with the new credit card. The problem is, once the world and everyone goes, hey, wait a minute, your debt keeps growing because there's interest rates on all these credit cards, eventually the U.S. is going to get cut off. And they're going to say, there's no way in hell you're going to pay off all this debt. You don't even have a job, and we're going to cut your credit because you have too much debt. And once the U.S.'s credit is lowered, his credit score, he's not going to be able to get new credit cards. And then he's going to start defaulting on the existing credit cards. And boom, there you go. Bankruptcy. So I just want to give you guys that analogy for the noobs. Let's listen to what he's saying. He also seems very fidgety. You'll see him like flip through his books and like move his hands around. I like to look at body language, and he's doing weird things with his mouth. He seems really nervous. And when someone's really nervous, they either don't know what the hell they're talking about, or they know something that they don't want to expose, right? Anyways, he was just saying, well, we're gonna do these repo operate. We're gonna go in and buy things and inject some liquidity into the market when need be behind the scenes, which is a form of QE, right? Behind the scenes. So, that's pretty much what he admitted to.
Victoria Guida with Politico. Another money market question. Banks have been pointing to liquidity rules as having contributed to some of the volatility we've seen in repo markets, and potentially some capital rules as well. Are you all looking at whether, some tweaks to the liquidity coverage ratio might help? And also, what is the status of the net stable funding ratio rule? Are you all still planning on putting that out soon?
So I think if we concluded that we needed to raise the level of required reserves for banks to meet the LCR, we'd probably raise the level of reserves rather than lower the LCR. I mean, it's not impossible that we would come to a view that the LCR is calibrated too high, but that's not something that we think right now. On the other hand, it might be that more reserves are needed, in which case we are in a position to supply them. In terms of the net stable funding ratio, I believe we put it out for comment and got comments, and I believe we're looking at finalizing that in the relatively near future.
Tweaks to the LCR. I mean, there's also been some talk about potentially giving banks some room in times of stress to maybe dip into their liquidity buffers.
And I think we want banks to use their liquidity buffers in times of stress rather than pull back from the markets and pull back from serving their clients as a general rule.
All right. Well, this is the concern over, not enough liquidity in the system, and that's because they started raising interest rates in 2018. And I guess just a couple just a couple percentages raised in interest rates already dries up the system, which is the interbanking system, right? The interbanking lending rates and all that, and the interbanking lending. And they're talking about, there's reserves, and then he also admitted to the fact they will reliquify the banks, give them more reserves. Was that a bailout? Yeah. So let's fast forward a little bit.
Our goals can in principle be something that monetary policy should take into consideration. And our discussions and the research we have suggests that trade policy is something that's weighing on the outlook. So
there you go. Blame it on Trump again and the trade war. He admitted earlier or after, I forgot when, but he says most of the U.S. economy is based off of the consumer. And I've said time and again, a real economy is not based off of spending. It's based off of savings and productivity. That's growth. Growth is productivity. It's making shit. It's not buying shit from China. So someone's got to do something about the trade deficit. And I think the only thing you could do is do tariffs and then force the U.S. to start making its own stuff. Of course, you can't do that without cutting regulations and taxes. So the problem is that the government's already like 30% of the U.S. economy. So cutting the size of government, cutting regulations and taxes also will put the U.S. in a recession. There's no way out. There's no way out. The only thing that can happen is the bubble and the debt bubble and this Ponzi scheme just, resets itself. And then the U.S. will recover if it can retool itself and manufacturing comes back. I don't think that's going to happen because Americans are dumb enough to actually vote in a commie, and that's just not going to bring any business to the U.S. If anything, people are going to be fleeing the U.S., and so will businesses and entrepreneurs and everything. So, that's what I'm thinking. What else are they talking about here?
Well, I think, I mean, it's a challenge. There's no simple bottom line answer where I can say, yes, I've got it for you here. But what it amounts to is this. What you see is probably the kind of volatility that's typical of an important, complex, ongoing negotiation. And I think what we need to do is to try to look through the volatility and react to the underlying forces, the underlying things that are happening that are relevant to our mandate. We have nothing to do with setting trade policy or negotiating trade agreements. We're supposed to be reacting on behalf of the American economy to support maximum employment and stable prices. So we need to look through what's a pretty volatile situation. We'll be looking for things that are affecting the outlook for the U.S. economy, particularly the outlook as it relates to maximum employment and stable prices. So all of those things in principle can affect the achievement of our goals. It's an unusual...
He's talking in circles. His Fed rate policy is the most important thing to the economy. And it was funny because on CNBC they were, the anchors were speaking, and at one point it's like the light bulbs clicked on, right, in their heads, and one of them said, "Is the stock market really dependent on these rate cuts and hikes?" And it's pretty freaking obvious. If he doesn't keep cutting rates, the stock market will fall. It will crash. And as time goes on, you need to keep pumping more money into the market to keep going higher. It takes more money to make it go higher. It takes more money and more money over time to keep it elevated, right? At its current valuations. Corporations can't keep doing corporate buybacks if they don't lower the interest rates for the banks to keep lending these corporations money so they could keep doing their corporate buybacks. It's that simple. And the anchors on CNBC were like, I mean, is this really what's going on here? It can't be that simple. It can't just be that simple. Yes, it's literally that simple. If you have a bubble that's been created by tinkering and centrally planning the interest rates and printing money, QE, since 2009, if you reinflated a bubble and you created a bubble, it's that simple. They have to keep lowering the rates, and then they're going to have to start printing money. Now, does the government have something to do with the economy and everything? Yes, absolutely. It's very simple. High taxes, more and more regulations equal less competition, destroy businesses. It destroys small businesses, which is the backbone of the economy. The trade policy. The trade policy is, in the short term, which is months and years, is bad for the economy. But for the long term, you have to bring manufacturing back to the U.S. and Europe. If you don't, China and India in the second world, right, in the third world, have the first world by the balls. They own them. It's whoever makes and produces is the power, the economic powerhouse in the world. It's not who just keeps buying shit and racks up debt, because that's basically what the U.S. and Europe's doing right now. And this is towards the end of cycles of, of empires. It's just how it goes. And I'm going to make that empires video, but I've been really busy lately with researching gold, silver mining stocks. All right. Let's continue.
Usual situation because the U.S. economy itself, the largest part of it, the consumer part of it, is in strong shape. The manufacturing part less so, but overall you see an economy that I think generally forecasts show growth similar to our own forecasts, coming at about 2%, which is
You just pretty much proved my point. Indirectly. He just said but what happens when the consumers maxed out their credit cards and the consumer can't keep up with inflation? No one's getting pay raises. You might get a pay raise, but it's not significant. If you move up in a company, and you usually have more responsibilities and you get paid more. That doesn't mean that you're gonna beat inflation. Let's say you're not moving up in a company. You had the same job title for the last 10 years, even 15 years, or the last 20 years. Your pay raises haven't kept up with inflation. Your debt keeps going higher and higher. Car prices, food prices, home prices, stock prices have been going higher, right? Everything is more expensive if you really look at it. Utilities. Price of utilities have been going up. The only thing that's gone down is maybe the price of gasoline. I don't want to get into that right now. Honestly though, when I was in high school, a gallon of gas was literally $1.
It isn't, precisely the right tool for every single possible negative thing that can happen to the economy, but nonetheless, it broadly works And we're going to use the tool we have, and if it comes to it, we'll use all of our tools. So that's how we think it works, and how we.
Okay, he just said, well, when it comes to it, no, I remember this question. The question was, what are you going to do because you're not dropping interest rates 50 basis points? That's what the stock market really wanted, and wanted it to go higher. That's what it needs to go higher, a 50 or more basis point cut. And someone asked, well, what if you're behind the curve and we go into a recession towards the end of this year, beginning of next year? And he said, right, we don't want to be too late, so we're going to keep monitoring it. And then if the time comes, if we have to do what we have to do, we will use all our tools. What's all their tools? We'll cut to zero. We'll print money like there's no tomorrow. It's pretty much what he's saying. He did say they do not want to cut. They don't want to go to negative interest rates. So I agree with that. They should just maybe go to zero, and then because it's more likely to blow up the bond market when you do that. So they're going to go to zero, and then they're just going to print money. That's pretty much what's going to happen.
It's very hard to say. It's tough to say. We'll use our tools to offset negative. That's really the job of monetary policy, is to the extent it can to offset things that drive us away from maximum employment and stable prices.
And Nancy Marshall-Genzer with Marketplace. Chair Powell, are you worried that the low interest rates are adding to or could create a bubble of consumer and corporate debt that could make it more difficult for especially consumers to recover from the next recession or survive the next recession?
So if you actually look at households, households are in very strong shape. They're less levered. They've got less debt. They've got more income relative to their interest requirements, and that they're in very good shape, much better shape than they were in before the financial crisis. So the household sector, as a sort of aggregate matter, is in very good shape. That doesn't mean that every single person in the household sector.
I think in 2007 and prior, in the early 2000s, people took on more debt because they never expected a recession in 2008 and 2009. And I feel like people do take on less debt today, possibly overall. But at the same time, corporations and consumers still have a lot of debt. The biggest debt is student loans, obviously. But I disagree. There's definitely data out there that I've posted in the past year or two that shows that the consumer is really tapped out on credit cards and auto loans and maybe even mortgages as well. So either he's lying or, their data is messed up, because who knows. I'm not sure. I'm gonna make another video. We'll look at the consumer. We'll see how much debt they're really in.
Sector is in good shape, but overall, it's really not a concern. The business sector is something that we've talked about a lot and studied a lot, and the situation there is that the level of debt relative to GDP in the business sector is at a high level. However, so is the size of the business sector. So actually, the business sector itself is not materially higher leverage than it was. Nonetheless, there are a lot of highly levered companies, and that's the kind of thing that happens during a long cycle when there aren't downturns. For now into our 11th year, you get.
All right, so you're saying because of this longest expansion in U.S. history for the stock market, you're going to get a lot of companies with taking on higher and higher debt because of the trend. And here's the deal. He also said that the financial market is large, which is the problem. That's the problem, right? So, again, the U.S. isn't manufacturing anything. but their financial sector is enormous. It's like a huge chunk. I don't know how much, maybe 18, 25%, something like that of the total economy. So government's 30%, the other 30% is financials. And then the other 20% is probably healthcare and services, right? Which I know doesn't, I don't have a pie chart in front of me. I'm just saying that they're large. People, you understand that financials is a byproduct of manufacturing. Financials is supposed to be a byproduct of manufacturing. So you have companies that make shit, and then you have people who work in cubicles, and there's a financial section built off of the corporations that make things, right? Like Ford Motor Company or, Goodyear Tires, something like that. And the problem is, if they don't make anything in the country anymore, let's say they do make a lot, they still manufacture, but outside of the country, but that money doesn't come back into the country, then what is all of this financial derivatives and hedge funds and people shuffling paper around for if there isn't a big manufacturing base? Does that make sense? So we're at the end of let's say, an empire that became an empire, became strong, became rich off of manufacturing, making things and selling it to the rest of the world. But now what happened is the manufacturing left because we became less competitive, and then a huge financial sector grew while that happened. And now we're living off of the financials. Basically, a big casino where we're just shuffling paper back and forth and trying to live off of it. And then they're printing money to keep it going. Now, if you understand if you understand the consequences that's going to come of this, it is scary. All right. All right. What else is he saying?
Samir Hussein, BBC News. Mr. Trump has been a very vocal critic of you and your colleagues, recently calling you boneheads, and just now has called you a terrible communicator. How do you respond to these criticisms?
Well, Trump, you guys have to understand what's going on. Trump's pretty much prepping the Fed because he needs a strong quarter in 2019, so he needs them to cut rates now. Because if you get a weak quarter, a fourth quarter in 2019, and the earnings are weak for corporations and all the companies for in the stock market, well, in 2020 you're going to get a recession. So Trump obviously it's a blame game, right? Trump is preparing everyone to blame the central bankers, right, for the coming recession because he's not stupid. He knows it's coming. He knows it's a bubble. He even said it during the when he was running in 2016. So Trump needs to keep the markets artificially elevated and the party going so he could get reelected, so he could finish his job of bringing back manufacturing to the U.S., even though it's probably not going to work because you really have to cut like a large portion of government spending. And you have to take away all the regulations so the U.S. could be competitive on a global scale, and so manufacturing actually comes back to the U.S. So right now, that's why Trump sends out these tweets, and he's either, pulling Powell's arm here and forcing him to lower interest rates so he gets the blame, right? And he's exposing that the Fed needs to cut interest rates to keep the party going. The stock market wants the same thing as Trump. And they're both going to twist Powell's arm to get him to cut rates more and more and have larger rate cuts. And they need to do it now before it's too late. They don't want the recession to begin, because then if he cuts rates, then he's going to have to cut rates to zero instantly and go straight to QE, and that's a whole nother. It's not the best way to buy time. That it would be better off if he cut rates now and then keep the party going through 2020, and then later on, he just comes out with QE to save the markets and the economy. Even though in the end, nothing's gonna save it. The reset has to happen no matter what. But in the end, they're just gonna have to cause massive inflation to get rid of all the debt. But for now, for the short term, to finish 2019 strong, it's extremely important for 2020 so the markets and the economy doesn't go into a recession in 2020. And that's the Twitter war that's going on, or the tweets from Trump, and that's the battle between the Fed and Trump. I think Powell personally is probably just trying to save ammunition, so when the recession comes, he has more ammunition and he has more rates to cut. Because if he cuts them all now, then he's not going to have that much ammunition for when the markets do dump. So that's the game.
Hi, Chairman Powell. Paul Kiernan from Dow Jones Newswires. You mentioned trade policy being a complex, ongoing discussion. What is your rule for stopping as far as interest rate cuts go? You referred to this as a mid-cycle adjustment. The median dot suggests no more rate cuts, but if we get continued kind of back and forth between the U.S. and China, trade policy uncertainty is going to remain heightened. So, under what circumstances would you say, I think we've cut enough, we stop now? And secondly, as leader of this institution, have you felt a need to take any steps to boost employee morale at a time when the president is constantly criticizing the Fed? Thanks.
I'd love to be able to articulate a simple, straightforward stopping rule, but it's really just going to be when we think we've done enough. And our eyes are open. We're watching the situation. We've cut rates twice. We've moved really through the course of this year, as I discussed. And we see ourselves as taking actions to sustain the expansion and thereby achieve our goals. And if you look at sort of things that are happening in the economy, I think I personally see a high value in sustaining the expansion because we really are reaching this positive economy is reaching communities that haven't been reached in a long time. There'd be great benefit in having that last as long as possible. That's all. So I don't have a specific stopping rule for you, but I think we're watching carefully, and there will come a time, I suspect, when we think we've done enough. But there may also come a time when the economy worsens, and we would then have to cut more aggressively. We don't know. We're going to be watching things carefully, the incoming data and the evolving situation, and that's what's going to guide our
All right, so there he sounded very, very genuine, right? And let me explain this. I think what he is thinking is that if he could not cut rates 50 basis points, because that's what Trump needs, that's what the market needs to finish 2019 strong, because if the fourth quarter is weak, earnings are weak right after the holiday season, it's gonna cause a recession or the reset in 2020, and Trump won't get reelected and the stock market's gonna tank, right? So you have to understand, I think he is thinking that he could get away with just a 25 basis point rate cut now, so he has more ammunition later, so he could still cut a lot more later, so when the recession hits in 2020 or whenever. And I think that's what he's thinking. It's better to have more possibilities and to be able to cut rates from a higher level than from a lower level. So, but I think he screwed up. I think he should have cut 0.50 basis points now, so we get a strong fourth quarter and third quarter in 2019, because that'll set the mood and the trend for 2020. And the consumer during the holiday season in 2019, later this fall, they have to go out and shop. So these companies on Wall Street have good revenue and earnings reports for the fourth quarter of 2019 to set the trend for 2020. But because he didn't cut rates 50 basis points, it might not be enough. And it might cause a recession either, in a few months or later this year or 2020. So, yeah, I think the market's going to pull back. They're hoping it's not going to start dumping. They're hoping the market just pulls back a little bit or just goes higher, but doesn't crash because he didn't cut rates even more. So you have to understand that.
The Fed and your fellow central banks have been sort of exploring the far reaches of what's possible for monetary policy, even going so far as to make rates negative in some cases with mixed results. Meanwhile, fiscal and regulatory, do you ever consider the limitations of monetary policy? Should you be more explicit about what monetary policy can and cannot do in this environment?
We try to be clear about that, but really I think our job is to use our tools as best we can to achieve, to do the jobs that Congress has assigned us, which is achieve maximum employment and stable prices. That's our real job. In terms of giving the fiscal authorities, who, by the way, are the ones who created us, advice about how to do their job, we keep that at a high level, I think. And at a high level, yes, I would say, and I've said before, that it's really fiscal policy that is more powerful and that has much more to do with fiscal policy can do those things that will increase the longer run growth rate of the United States by improving productivity and labor force participation and the skills and aptitudes of workers. All of that comes from the private sector, but also from more of the kinds of things that can be done with fiscal policy.
I actually agree with that. Like I said earlier, with regulations and endless government spending and running up the debt, right, for government programs, wars, welfare, regulations, that's what destroys the economy. The central bank destroys it as well by printing. But they wouldn't have to print if honestly the government just got out of the way and let the free market do its thing. But we don't have a free market. We never did in the U.S. Not since there was a central bank, and not since government started growing huge and getting its paws around the free market. We would still, there's still booms and busts in a free market, but they're nowhere. But they don't affect the real economy. They only affect the financials, and that's what happens in a free market. So you would have bubbles all the time, but the only people who would get hurt are the ones who participate in the bubbles. But the real economy would be fine. You would barely notice it. Like, you might get a slowdown every couple of years, but then the economy would just grow back even stronger every time in a real free market. Problem is, with so much intervention from politicians and now central bankers, right, that doesn't happen. They just create giant bubbles that destroy the economy and create endless debt and free promises, right?
Over the long run, we can't really affect the growth rate of the United States. The potential growth rate of the United States is not a function of monetary policy. It's a function of other things. So I try to be clear about that. And but ultimately, fiscal fiscal authorities will do what they seem appropriate.
Treasuries, and even that was partly maybe to blame for the liquidity crunch in repo markets that we saw this week. I mean, does the Fed have concerns over the impacts of a global glut for U.S. debt? Is that a conversation that you also have with Treasury Secretary Mnuchin about what the proper way to maybe address some of the challenges down the road with that type of kind of heavy interest globally?
Not really, no. That's really Treasury's job and Congress's job in terms of, well, there's how much to spend and how big the deficits are, and there's how to finance it. And none of that really calls for advice from the Fed. We take fiscal policy pretty much as exogenous to our work. Now, that doesn't stop us from time to time from saying that we think it's important that the U.S. Fiscal picture return to a sustainable footing. And right now it's not. That's been the case for a long time.
Yeah, and if you just look at the numbers, it's impossible. There's no way that university professor just came out with that report. The U.S. is really in $220 trillion in debt. There's no way to pay off all of the promises of the pensions and all that politicians have made over the years. You have to understand, politicians, they will give the people what they want, just to get elected and to stay in power, to keep their jobs. And that's why democracies don't really work, because people, once they figure out they can vote themselves free shit, they destroy the economy. And that's where we are today. So I think that's pretty much it
in setting our interest rate policy. Thank you very much.
I don't know if they only have a set time, like 1 hour or something, and he just says, "All right, thank you very much," and just walks off. It's pretty funny. All right, let's look at some charts. I am still holding on to my my bullish trade on gold, although metals did dump because we only had a 25-point rate cut, right? But I think this is a knee-jerk reaction. This is a 1 hour chart. A lot of buyers did come in, so that's a good sign. And the price did get back above 1,500. As long as the price can stay above 1,500 the rest of this week, I'm still actually bullish. Now, why is that? It's because, I said that the market has already priced in a 25 basis point cut. It really has. And I talked about that in my last video. And I think that prior to this weekend, I think investors are going to get out. They're going to take profits. Well, traders and speculators, they're going to get out. And we're not going to make a new all-time high. I could be wrong. He should have cut 50 basis points. Because this entire move right here, this is the S&P 500, 4-hourly time frame. This move right here, move up to the upside. Well, they cut rates again for the first time in many years, right? Right around here. That was the catalyst for the move. But I think the rest of this move was because they anticipated another rate cut. So it's baked into the cake. I mean, it might pop and make a new all-time high for the short term, but I think it's going to fall back down then. Because you have to understand the dynamics of this entire market. It needs more money, more liquidity. Now, could the Fed keep it up for the rest of this year by doing, under the table repo purchases, this and that? Yeah, maybe. But I think we're going to see a pullback, a correction. And you know what's telling me that? It's the Russell 2000. The Russell sold off. Meanwhile, the NASDAQ and the Dow Jones and the S&P rose. The Russell 2000 is 2,000 smaller companies, domestic companies for the U.S. Also, transports are getting hit hard. FedEx's stock plunged today. So, that means people are buying less stuff, even online. So that's it's a red flag. So I would look at the Russell 2000. If it keeps selling off, that's going to be a precursor to the rest of the equities markets and indices to fall the rest of this week, next week, and the week after. And I think that might happen. And if the markets fall too much, let's say the Russell 2000, it falls below support in the previous lows around 1460, 1500. I think the Fed will panic and they'll come out and they can cut rates at any time. They don't have to do it on these scheduled FOMC meetings, right? They'll come out, they'll say some words. They'll come out with words and they'll publish articles or they'll say something to calm the markets. But if that doesn't work, they will come out and just cut rates. It won't be a scheduled FOMC. So I would look at the Russell 2000 for that. Honestly, I mean, the RSI is overextended, momentum overextended, MACD overextended. The Russell 2000 is going to sell off. Transports are probably going to sell off. Let's take a look at transports. So I'd look at the S&P or the Russell 2000 and the transports. If they continue to sell off, they're going to sell off first, and then the Nasdaq and the S&P and the Dow Jones will go afterwards, and then the FANG stocks. Let's take a look at the FANGs. All right, here's the FANG stocks. It looks like it's almost in a descending triangle. I'm still holding on to my gold ETF long. I think the markets, they're going to take profits on Take Back Friday or Thursday tomorrow. And I think metals, if the markets fall, metals are going to go higher in anticipation of the Fed capitulating even more and then cutting rates unexpectedly or unscheduled. And, Trump's going to come out with tweets. The news cycle is going to be important to what Fed officials say, on the board, and what Trump says, right? The only other thing that can make the market go up higher is if Trump capitulates on the trade, which it kind of looks like he's doing right now, to keep the market higher so we have a strong fourth quarter for 2019. That's the game, all right? So the next Fed meeting is October 29th and the 30th. So there's another Fed meeting. So that's why he didn't cut 50 basis points. He's gonna be able to. There's another one coming up pretty quickly, so he's gonna be able to cut rates as necessary to keep the market artificially elevated or to make it go higher and hit new all-time highs. There's also one in December, but by then it's too late because Christmas shopping does start in October. All right, guys, smash them likes. Leave anything in the comment section. Let me know what you think. I will respond to you. Please share my videos. It's the only way my YouTube channel grows. I have 2 YouTube channels. Just type in MMGinvest with a space and without a space between the 2 words. And go to my website if you're interested in data and the private room for gold and silver mining stocks. I believe that'll be the biggest opportunity for the largest wealth transfer in human history that may change your life or may not. Alright guys, until next time.